The real employment data the government does not want you to see. Now, last week, a bunch of news came out, the employment data came out, and it was amazing, right? Well, maybe not. The information that you're seeing is not the real data, but don't worry, I got your back. So in this video, I'm gonna break down the government report that came out that shows the employment data that everybody's so happy about. We're gonna dig in behind the top level numbers so I can show you what's really going on. And then I'm gonna explain what exactly this means and how we can know what's really gonna happen based off of the real data, not the made up data that they're talking about. I'm gonna break this down through just a handful of charts. I'm gonna try and go through this pretty quickly, so let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss and I make these videos to change the way you think about money because almost everything you've learned is wrong and almost all the data that's being presented to you is wrong. And even if it's not wrong, how do you make sense of it? And then more importantly, how do you take action on that? Now look, I know you're one of the many people who are awakening and I congratulate you for you wanting to dig in and learn this. And so I'm gonna take these complex subjects and make them easy to understand so you can take action on this. Now real quick, before we jump in, I'm gonna show you all these charts and graphs, but I do wanna let you know that next week I'm hosting a live event. I'm doing it off of YouTube. It's gonna be about an hour. I'm gonna go through a whole bunch of charts and graphs and slides to show you what I think is really happening and what I'm doing about it, what I'm buying, what I'm selling. And I'm gonna go into Q&A if you wanna join and ask questions. There's a link in the description down below if you wanna check it out. Come hang out with me live for about an hour. I'll answer all your questions. It's free. All right, let's go ahead and just jump right into this video. Okay, so the first thing is before we get to the jobs data and the real data they don't want you to see and understand, the first thing is, what is a recession? I saw a meme, I don't have it, I should have probably pulled it up, but it was a meme of, I think it was Joe Biden and like, hey, can you define a recession? And he's like, I don't know, I'm not a biologist. And if you get that joke, then you know what I'm talking about. But we can't define what a recession is anymore, sort of like we can't define what sexes are anymore. But the White House had to come out ahead of the GDP numbers to tell us what the new definition of a recession is. We'll get to that. But what we can see in this Yahoo article, and this is a key piece to what we're talking about today, no, they're not changing. They didn't actually change the definition of the recession. I'm going to look at that. But what we can see here is it says that the economy is currently adding too many jobs to officially be in a slump. So this is what the White House press put out. The economy is currently adding too many jobs to officially be in a slump. That's their data point. So we're going to dig into that data point. Also, I wanted to show you this real quickly. So this is off of Investopedia. I go to Investopedia. You notice I use it a lot in videos. I like to be clear on what the definition of words are. So I use this a lot. So we can see Investopedia, which is a good dictionary for these types of words. But look, the term of recession was updated July 29th. So what is a recession? Well, they went and changed the definition right when the White House came out with this. So just know this is an updated definition. But per what they give us as the definition today, one popular rule of thumb is that 2 consecutive quarters of decline in a country's GDP. So we saw that. Quarter 1, negative GDP. Quarter 2, and this is why the market rallied, we were expecting about a negative 1.6 GDP print, and we got a little bit better than that. Okay, now, according to updated July 29th, economists define a recession as recessions typically producing declines in economic output, not GDP, consumer demand, and here's the key, here's the kicker, and employment. So now you understand why this jobs number was so important for the Fed, but I'm going to show you why the data is completely wrong. Before we dive into that, I want to show you this quick video that we have here of Bullard explaining what the Fed will need to keep hiking rates. Remember, everyone's looking at the Fed. Are they going to pivot? Are we going to go back to quantitative easing? All these types of things. Well, let's hear directly from the Fed about hiking rates and recession. Let's go ahead and play that video.
We're not in a recession, in your view, and we may be able to avoid a recession.
Yeah, as the chair said, you know, we're not in recession right now. We do have these 2 quarters of negative GDP growth. To some extent, a recession is in the eye of the beholder. There is an official dating committee, which isn't really official, the NBR dating committee. And that's really Bob Hall, professor at Stanford, so he makes the call. But with all the job growth in the first half of the year, it's hard to say that there was a recession. With a flat unemployment rate at 3.6%, it's hard to say there's a recession. So the second quarter slowdown was I think, more concerning. I think the first quarter slowdown was, negative GDP was probably a fluke, but the second quarter, I think, was more concerning. And so I'll watch that carefully. But now what I think is going to happen in the second half of the year is that we'll get positive GDP growth in the second half. I think we'll have a reasonably good third quarter here. And so I think jobs will also hold up over the second half of the year. Job growth is slowing, but is slowing to a trend pace. So that's how I'm assessing it right now, but I'm watching it closely.
Okay, so there you heard it right from him. Back onto this one data point. Now remember, the Fed has said they're going to be data-driven. And so they're looking at the data, and this employment data is one of the big pieces that they're looking at. I'm going to explain what this means, so stick with me. Now the Fed and the administration are telling us not to worry. I think it was Ronald Reagan who said the most dangerous words to hear from the government is, "Don't worry, I'm here to help you."
The 9 most terrifying words in the English language are, "I'm from the government and I'm here to help."
All right, the job market stays red hot with unemployment rate near a pre-pandemic low, historic rates. I'll show you about that in a second. The labor market is strong enough to take more rate increases, the Federal Reserve official says. So we can keep hiking rates because the market, the economy is strong, the job market. So let's dive into this data. So here's the data, all right? We had a great report. Everybody's cheering, congratulations. What we can see here is this change in non-farm payrolls. Non-farm jobs, the change, this came out August 5th, was an actual increase of 528,000, almost over 500,000 jobs. All right, the economy is doing amazing. Look at all these people we're putting to work. They say that the unemployment rate is now 3.5%. That's historic. That's great, pre-pandemic, right? Okay, well, let's take a look at that. Now, a couple things that I want to dive into in this data is the first is that non-farm payrolls this month beat expectations. So what happens is when you're a publicly traded company or when you're the government, you put out a forecast of what you think your sales, your profits, your expenses will be. And then if you beat it, it's typically good. When you fall less than that, it's usually a bad sign. But here we beat it. We beat expectations of job growth. The economy is doing way better than we thought, not just by a little bit, but by double the expectation. We beat it by 278,000 jobs more were created than they had expected. And then unemployment fell, of course, because of that. The average hourly earnings rose as well. Wow, it's amazing. As a matter of fact, the average hourly earnings went up by 0.5%. So you're making more money. Do you feel more rich? Of course, I know the answer to that, and I'm going to explain to you why. So I'm going to show you some charts and graphs that explain why that is the case. Of course, it doesn't take a genius with inflation at 9.1% and you're making 0.5% more money. Yeah, you do the math. Okay, now, do we believe our eyes of what the Fed is showing us, or do we dig into the data? Of course, if you're watching this channel, then of course we're gonna dig into the data. If you like that, give me a thumbs up on this video so more people see this video, and while you're at it, hit that subscribe button and the bell notification so you know when I put videos out. That pesky algorithm sometimes doesn't like to show my videos. I guess they don't like the things I'm telling you, but let's dig in anyway. So data comes from 2 different surveys. Where does the BLS, Bureau of Labor Statistics, where do they get the data to show that all these jobs were created? Do they ask every single employer in the world? Of course not. So they get it from 2 different surveys. So the 2 surveys, one is the unemployment rate. Okay, the first thing they do. And what they do is they survey households, and they survey about 60,000 households. So there's 330 million people in the United States, and they're gonna ask 60,000 households about the unemployment rate. Sounds like a pretty good sample size to me. Just kidding. But they reported only 158,000 jobs. All right. Then we have the payrolls. This is called a payroll survey report. And on this, they go to the real good source of data. Of course, they ask government agencies. And they surveyed 131,000 business that are in the government agencies. So this is a bigger sample size, 131,000, but of course government agencies, and they reported 528,000 jobs. So we have 2 surveys, we got 2 different numbers. The one that they actually asked household, even though it was a small subset, got 158,000, but the governments had over 500,000. So which one do you think they go with? Of course, they go with the governments. Now, why are these so wrong? And more importantly, why are they so different from each other? So what we can see is that we have the two. So the purple is the adjusted household survey employment. The red is the household survey employment. And this yellow is the payroll survey employment. All right, so we can see the purple and the yellow have moved pretty well together this whole time. And then we had this big drop, obviously this is March of 2020. But now what's happening is you can see this discrepancy right here. And more importantly, I don't know if we can zoom in enough on this, what I really want to bring your attention to is these are going straight up vertically right here, but this right here is rolling over. Maybe editor can zoom in on that so people can see this. But what we can see is that the household survey employment is actually flatlined. It's not growing while the other ones are going up. So why is there such a big discrepancy of that? The other thing is we want to take a look at what types of jobs are being created. Not all jobs are equal. If you get a job as a white-collar professional in software development or accounting and you're making $250,000 a year, or did we add a job working at the fast food joint for minimum wage, right? Not all jobs are the same, and we have to look at the makeup of this. And so what we can see is we have full-time workers in this column right here, and what we can see going from right about here, from March of 2022, we can see the amount of full-time workers is actually going down. 132.7, 132.0, 132.8, 132.6, 132.5. That's a downward sloping trend. That's not good. That's full-time employment, but I thought all these jobs were added. So where did they get added? Well, here we have part-time workers, and what we can see there is it's going up from 25.4 to 25.8. So we're losing full-time workers and we're gaining part-time workers. You can see not all jobs are created equal. Then we have total multiple job holders, and this is a key piece. What we can see here is the multiple job holders went up. So we've lost full-time workers, but what we've gained is part-time jobs and multiple job holders. All right, so you got to dig into the data. The other thing that's important to look at is the consumer price index and the unemployment rate. So what we can see is the red line being the unemployment rate and the blue line being CPI. So when inflation gets really high, we see the unemployment rate spike. You see that? Now, what do you think comes after that? Do we see the unemployment rate spike really high? You're starting to see this pattern right here, right here. All right. But let's keep digging in and let's find the real data here. All right, what's the trick here? Why are these two numbers so far off? Besides the obvious of asking different people, taking different sample size. But there's a trick here, all right? The trick is something called the birth-death factor. And what this takes into a consideration, or really it's a guess of the number of jobs that have been created or destroyed. So let's just guess how many jobs have been either destroyed or guessed. And then we're also going to guess how many businesses were started or destroyed. Now, where do they get that information from? Well, they get it from the previous year. So they look at last year's data and go, well, last year, this many businesses were started and this many jobs were created. So then we're going to have the same amount of businesses created and jobs, okay? I mean, it sounds kind of reasonable. If you're going to take a guess, I guess that's a good sample to take it from. But the problem is when you have an outlier year. So in 2020, all businesses were shut down. Everybody lost their job. What happened in 2021? Well, a lot of businesses, not all by a long shot, but a lot of businesses opened up. A lot of new businesses opened up, and a lot of people went back to work. So we had this massive year for businesses created and massive year for job growth because of what happened the previous year. So they're guessing the number of jobs created this year and businesses started this year based off of last year's data that was this giant, crazy outlier. You see the problem in this method. Now, what happens with that? Well, they had to make an adjustment, okay, based off of this, the birth-death factor. And because of that adjustment, they added over 300,000 jobs, 309,000 jobs, 309,000 jobs. That's the sixth highest monthly adjustment we've ever seen in over 20 years. Of course, because they used an outlier set of data. Now, another piece to throw into that is, remember those two numbers, the discrepancy? What was the difference of the discrepancy? Oh yeah, if you're good at math, you guessed, it's that number, the adjustment data itself. All right, now let's look at the actual employment number. So the employment's low, right? 3.5%. It's historically great. Per the White House press secretary, the economy's never been better. We have record low unemployment. Okay, unemployment is low, but First of all, that's assuming their data, which I've already showed you that data is full of holes, but it gets worse than that. This 3.5% level hasn't been breached in 50 years, so we're at historic rates. They're not lying. It's what I call factually accurate, but intellectually dishonest. All right, so they're telling you kind of a partial truth to tell you the story they want, but they're not really giving you all of the data, so they're really being dishonest. It's like when your little kids tell you kind of like a half-truth. It's still a lie, right? At least in my household, we consider that a lie. All right, so it's the lowest level it's been in 50 years, which isn't that bad, right? But what we can see is that unemployment is somewhat of a lagging indicator. Unemployment always seems to bottom before the recession breaks out. So what we can see here is that unemployment, these red lines, by the way, these are recessions, all right? So you can see that. These are recessions right here. And what we can see is that unemployment bottomed here before the recession. Unemployment bottomed here before the recession. Unemployment bottomed here before the recession. Unemployment bottomed here. Unemployment bottomed here. Unemployment bottomed here. So now how do you feel about having record low unemployment? As a matter of fact, it would seem like it'd be better when unemployment is actually higher. See how much distance we have when it's higher before we get to the recession? So unemployment by itself isn't that good because it's a lagging indicator, all right? We need to look at other pieces of data, and I'll show those to you. All right, JOLTS job openings. Now, these are about the unfilled positions. These are the amount of jobs that are open. Now, you've probably gone downtown to your main street, and you've seen all these businesses with help wanted signs. As a matter of fact, in my little town here on the beach, there's a restaurant that we like going to, and the other night, we were riding bikes, and I told my wife, hey, let's go to that restaurant and get some food, and she said, oh, I think they closed down. I'm like, they closed down? They're always packed out. She said, yeah, they had to close down because they can't get people to work there. Anyway, crazy. Unfilled positions are falling fast. So what we can see is that this is the job openings, and we can see that this has moved. This goes back to 2016. And so it's been a pretty steady trend, you know, not a big alarming. Obviously, this is March 2020 when the whole world cratered. We kind of got back right here, but then it started taking off. Now, the reason why I like to show you charts with this is because I want you to see the direction and the speed at which these move. So what we can see right here at this peak, look how fast this is starting to come back down again. All right, so I want you to see that as a chart. Now, this is the third biggest drop on record. Third biggest drop on record. That's not a good thing. All right, let's look at it from another way. All right, the initial jobless claims are rising. So when people lose their jobs, they go file for unemployment. People seeking unemployment benefits file for this. And this is really what we would consider a high signal indicator. Remember, when we're looking for indicators, we're looking for multiple. Usually we're looking for leading indicators and not lagging indicators. So this is a high signal indicator, and what we can see is that it's turning up just like in 2008. So this red area is the 2008 Great Financial Crash, and what we can see right here, notice how this is turning up right before the 2008 crash, and what we can see is this same pattern starting to take effect right here. See that? Right before this, and now we have the same pattern showing up right before that. So that's not a good sign. Now remember, no one indicator is conclusive, so we're looking at multiple indicators, which of course I'm showing you multiple indicators. All right, now what about the income? Well, unfortunately, income is expected to fall. Now there's been multiple surveys that have been done. One of the best surveys, most recognized surveys is from the University of Michigan. And they've ran a lot of surveys, and they're very respected, and they found that it's the worst sentiment they've seen since 2008. That's not a good thing. When people have a poor outlook of the future, it tends to become somewhat of a self-fulfilling prophecy. If I feel that I'm going to be more poor in the future, I'm going to hoard what I have. I'm not going to spend. I'm not going to go to dinner. I'm not going to go on vacation. I'm not going to buy that new car or whatever. And when I don't spend, then other people don't have enough money, and it starts to become a self-fulfilling prophecy. All right, what we can see is that the income expected to fall and people losing a job is one of the worst that we've seen. This is the change over the next 12 months. So this measures the change. Of course, March 2020, there was a massive change in people's income. When they shut down your businesses and tell you your job is non-essential, of course you don't feel good about the future. You expect your income to go down when they shut your business down, right? Or you lose your job. And so that would be normal or expected here. But what about this drop right here? Look at the speed of that drop. That's the change. Look how fast that is. Remember, that's why we look at these charts to see this. This is not good. As a matter of fact, the survey shows that I believe 65% of all businesses that are somewhat in the transportation sector, which of course is a lot, 65% of them aren't able to pay their monthly rent for their building. I believe it's 35% of all small businesses can't pay the rent. 55% of small businesses think they'll be out of business by next year. Those are not good data points to have. All right, now here's where things start to get even more interested in this data. All right, so now look, economists, they like to use a lot of technical jargon to make things seem complicated, PhDs, but the reality is that economics is actually very simple. It's just rational thought. That's it. It's very simple. I'm going to break this down in a way that you've probably never expected after I show you these next couple charts. But we have to look at this, stretching our wallets. So what we're seeing, in addition to the sentiment being very low and people thinking they'll be out of business next year and unemployment being low, unemployment low, we've added all these jobs, we've added part-time jobs, right? All these things. We're seeing all of this in the data because what we can see is that personal savings are actually at a 12-year low. People don't have the savings. Now you need savings because that's like your battery, all right? A battery, you need a backup. So if you run out of juice, you need to have a backup. If you run out of, if your job isn't paying you enough to live off of, you need that backup battery. That's your savings. If you don't have that, you're basically like a slave. You're stuck, right? What we can see is that personal credit is exploding. So not only do we see that the savings are low, but now people are borrowing more than ever before. I pulled up this chart from Joe Consorti. Give him a follow on Twitter. I don't know if we can link to it up here, but just check him out, Joe Consorti on Twitter. He helps me out with some of these slide decks. Shout out to him. Consumer revolving credit is skyrocketing while personal savings are at lows not seen since 2009. Not good. So savings are down, borrowing is up. People aren't just stretching their dollars in response to this inflation, they're stretching their credit cards. They're stretching their credit cards. So we can look at this chart. We have it right here. Now, just note that this is a leading indicator for layoffs here. Now, what we can see here, back to 2008, remember the red area is the crash. And what we can see when the debt gets really high, and we saw it right here in the 2020 crash, and now we're starting to see it right back here again. Look at this level. So we're higher than we were in 2008. We're at where we were in March 2020, and we're at those levels again. Okay, so remember, the Fed's being data-driven. So this is the data that they're really going off of. This is why they're publicizing this so much. Gaslighting us. The economy's never been better historically, as the White House press secretary would say. All right, strong labor equals more hiking runway. So that's the question in everybody's mind. When will the Fed pivot? When will they stop raising rates? When will they start lowering rates, go back into quantitative easing? So what we can see is that a strong labor report is good for the Fed. They want to see that the economy is strong so it can handle more rate increases. They need to try to get the rates up as high as they can so they have more room to bring them back down. And so they want to see the economy is strong and it can withstand that. That's exactly what they're looking for. They believe the markets can handle more rate hikes. And so the market is actually kind of telling them the same thing. I've used this chart before, and so keep an eye on this. This is the 2-year Treasury yield versus the Fed funds rate. And what we can see going way back here to the year 2000 is that what we can see is this white line is the 2-year rate, the 2-year Treasury yield, and this blue shaded area is the Fed funds rate. And what we can see is as the 2-year Treasury goes up, the Fed raises, but right here it reverses. The Fed gets stuck as the 2-year Treasury starts coming down, and the Fed has to get really fast and aggressive and start lowering rates. And then right here, the 2-year starts taking off again. So what does the Fed do? They raise rates. Now, this might surprise you if the first time you're seeing this. When did this start happening? This was about 2004. A couple years before the great 2008 crash. But Mark, wasn't it caused by all those greedy homeowners that bought all those houses? Well, actually, this kind of told us what was happening back in 2004. So the 2-year was running away. The Fed started chasing it, raising rates. When did they stop? Well, the 2-year came down here, and now all of a sudden the Fed was caught, and they had to start drastically cutting rates. And they did, boom, all the way till 2008 when we had the big crash. Okay, so then rates come back down. You can see rates have basically stayed here flat like this. The 2-year has basically stayed flat with it. And then here we have Jerome Powell comes in the Fed. He's all fired up. I'm going to change the system. I'm going to normalize this. I'm going to get us off of zero. So the Treasury yield starts going up. And what did Jerome Powell do? He started chasing it, raising rates, raising rates, raising rates. If you remember, in December of 2018, there was a big market crash. Because why? Because the Fed tightened things and they had to quickly reverse. And you can see that the 2-year started crashing and then they started lowering rates, lowering rates, lowering rates, lowering rates until what? Oh, the 2020 crash. Could it have been that the markets were already crashing before the pandemic? No way, Mark. You can't tell me that, right? Well, if you've been watching my videos for any period of time, then yes, I am telling you that. Now, why am I showing you this? Because where are we at today? The 2-year is going through the roof. The Fed is chasing raising rates. So when are they going to pivot? Well, they're going to pivot when the 2-year starts coming back below what the Fed funds rate is. Right now, they're both going straight up, and so we're going to keep our eye on that level. Of course, they're being data dependent, so they're also going to be looking at this jobs report. All right, now, real wage growth is negative, and this is the key piece. Going back to what I said before, savings are low, credit card debt is extremely high. Why is that? The reason why this is important to understand is because without looking at this data, all of the other data is worthless. That's why I put it at the end. All of that data is meaningless without looking at real wage growth, all right? Because as I said, if your wages go up by 0.5%, but inflation's going up by 9%, you don't have 5% or 0.5% wage growth. You have a negative 8.5% wage growth. You're losing money even though you're making more money. So what good is full employment if everybody's getting paid 5 cents an hour? Imagine that. So the whole economy is working 100% full employment, but everyone's making 5 cents. It'd be worthless, right? Think about it like that. So what can happen is everybody can be working, doing lots of low jobs, while inflation is running high and everybody's quality of life is going down into the toilet, even though wages are going up. Everybody's working. Everybody's working as a slave. Who cares? You have to look at this data together. Now we've seen that wages adjusted for CPI, so when we adjust wages for inflation, what we can see is look how far those wages have come down. As a matter of fact, it's as bad as the early 80s when Jimmy Carter was president. It's that bad. The earnings, the amount you're getting paid, are not keeping up with inflation. I have to repeat this over and over. Looking at the unemployment number by itself tells you nothing. What we want to look at is the amount of money people are making in real wages adjusted for inflation, because all that matters is that your quality of life is getting better or worse. That's all that matters. And if it's up to me, I want your life to be better, which of course is why I make these videos. Now your government, on the other hand, they don't really seem to care so much. All right, what comes next? So now that you understand all this real data, what does all this mean? What do we expect? Well, I would expect for rates to continue going higher for some time. Continue to watch that chart I showed you, the 2-year and the Fed funds rate. That's an important chart to watch. Also continue to watch for the data the Fed puts out, because they said they're going to be data dependent. So when they show you these strong data numbers, that makes them also believe they have more room to run as well. But history tells us what comes next. We know that low unemployment is unfortunately a sign that recession is coming next. The near out term doesn't look super good. We have high levels of debt in the consumer space and in the business space, the public and private debt. Low levels or high levels of debt with low levels of savings, those don't add up to good. I expect inflation will rage on. The Fed will be powerless to stop it, and I think it's going to backfire on the Fed target to get them back down to this low inflation of 2%. Those are my predictions. Now, what are we going to do about it? Well, like I said, I'm going to do about an hour presentation on that. I have way more charts and graphs. I'm going to show you what I'm buying, selling, what I'm going to do about it. I'm going to open up for question and answer. If you want to join me, there's a link in the description down below. I'm doing that next week. If not, hopefully you enjoyed this video. Of course, as always, give me a thumbs up on this video if you like it. If you don't like the video, that's okay. You can give me a thumbs down, but at least leave me a comment and tell me why. And while you're at it, of course, hit that subscribe button so you know when I put new videos out. And that's what I got for you today, all right? To your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably gonna really like this video right here and this video right here.